Welcome everyone. Welcome to our first webinar focused on professional service firms. My name is Anna Jarrold. I'm a tax partner and head of our professional services tax team in the UK. For those of you who don't already know, BDO is a global accounting network providing auditing, accounting, taxation and consulting services from over 1,300 offices worldwide. We're now in 154 countries with over $7 billion in revenues and 60,000 people all over the globe. I'm joined by a number of international tax specialists from the network. Before we get underway, I will run through some housekeeping. We really like your views, so we'll be running a poll throughout the webinar. These questions will not be announced, but will appear from time to time on the right-hand side of your screen throughout the presentation. There will be 5 polling questions to answer. You can ask questions during the webinar as well. Please use the Q&A feature, which is in the top right-hand corner of your screen, and send questions to all of our panelists. We'll address as many of the questions as we can at the end of the webinar, or if time does not permit, after the webinar. We're also recording the webinar, and we'll email you the slide deck as well as a link to the recording in a few days. This email will also include a link to a survey asking for your input on this webinar, as well as your suggestions for topics that you'd like to see covered in the future. Please do complete the survey, as we'll use your feedback to improve our output. We will finish within an hour. Today's webinar won't cover all of the OECD BEPS recommendations. Rather, we'll focus on those key recommendations that we will think have the most impact on multinational professional service firms and how they manage their global tax exposure. After a brief introduction by me, I will pass to Zara Ritchie in Australia, Jay Tang in China, who will both cover the transfer pricing and new country-by-country reporting requirements. Malcolm Joy in the UK will then deal with the recommendations on interest deductibility for international businesses and hybrid financing arrangements. And Dirk Elbert in Germany will provide an overview of the recommendations to prevent treaty abuse and the impact on the recommended changes to the definition of permanent establishments. Finally, we pass back to Malcolm to provide a summary of provisions around harmful tax competition and the impact of the recommendations. If we do have time, we'll follow this with some further observations and a Q&A. But first, I'm going to give you an overall introduction before turning things over to our panel. The OECD project was triggered as a direct result of global financial crisis that started in 2008. As a result of the crisis, many governments saw their tax revenues drop substantially. This ultimately resulted in the spotlight being turned on multinational businesses and the amount of tax they were paying on their global profits. Several high-profile cases were highlighted in the media, with Amazon, Google and Starbucks being examples, focusing on their global profits. This led to the view held by politicians and the media that multinational groups used the international tax system in the way that it was never intended to be, to substantially reduce the amount of income taxes they were paying. The belief was that the international tax system was no longer fit for purpose, and in 2013, the G20 countries asked the OECD to look at these issues and make recommendations on how the international tax system needed to be fixed. In July 2013, the OECD released a report action plan on base erosion and profit shifting, and set out a very aggressive timetable to analyse 15 action points and make recommendations. These action points all sit under one or more 3 core principles of the BEPS project. The first principle is coherence, and establishing international coherence in corporate income tax. Coherence is achieved when the tax rules of different countries ensure that income earned by a multinational group is subject to tax and cannot minimise or eliminate taxation by exploiting differences in the way countries treat a particular amount. The second principle of the BEPS project is economic substance, restoring the full effects and benefits of international standards through realignment of taxation and relevant substance. So in other words, this is the principle that taxation for a multinational group's profit should happen in the jurisdiction where the business activity that generates that profit occurs. And finally, the third principle is transparency. This relates to disclosure by taxpayers about where their business activities are carried out, where they are paying taxes, and what their planning activities are. It also relates to improvements and mechanisms to improve how tax disputes are resolved. So in performing this work, the OECD went beyond consulting the OECD member countries, and 62 countries were involved directly in the consultations, including non-OECD members such as China and India. The OECD believes that this process has been an inclusive process and one that has never been undertaken before on tax issues. The final recommendations were issued on the 5th of October 2015, and the OECD has now started to focus on working with countries to actually implement the recommendations. All of this will impact professional service firms, and to put this into context, professional service firms can operate in the most complex structures, dominated by either partnerships or companies or a combination of both over the world. These structures can be seen as opaque or transparent depending on wherever you are in the world and can be quite fragmented for various reasons. For example, some professions dictate that certain parts of a global practice need to be owned outside of the main group structure, for example, architects with a practice in the US. Or due to the transparent nature of partnerships, certain parts of the practice may be owned by local partners along with a select few partners from the rest of the group. However the firm operates, having a central approach to the tax strategy is important to give the optimum group outcome rather than just the best local outcome. It is key that the tax tail does not wag the commercial dog, of course, but if tax isn't considered, a project's profitability can quickly become eroded or losses not used to best effect. There is no doubt tax should be fully taken into account in commercial decision-making. If tax has not been high up on the agenda at this point, perhaps all the BEPS changes will bring it into greater focus within the business. What does seem to be clear is that each tax authority wants to collect more tax, and this is all combined with the fast-changing commercial environment. It's an interesting time for us all. At this point, I'll hand over to our first speaker, Zara Ritchie.
Thank you, Anna. I'd like to just perhaps start with an outline of, at a very high level, what the transfer pricing changes have been. The concept here is really trying to align transfer pricing outcomes with value creation. I think it's fair to say that there aren't any fundamental changes to the transfer pricing guidelines that have been issued by the OECD, but there's very much a sharper focus on what the key elements of a transfer pricing analysis need to include when one's analysing the international dealings within a multinational group. There is particular emphasis, including a rewrite, on intangibles and risk allocations, and importantly, whilst it's not prescribed in the OECD guidelines, it raises the focus and the importance of a very good quality analysis of a business's functions, assets and risks, and how to identify the evaluating activities and how important that is in practice. Transfer pricing is extremely complex, as I'm sure many people are aware, having done any transfer pricing analysis. It's an art, not a science. There is a significant risk where transfer pricing is not analysed or outcomes are not properly analysed. Adjustments can be significant if a tax authority reviews transfer pricing arrangements in one jurisdiction. It can create double tax if that adjustment is not equally made in the other jurisdiction, and any transfer pricing adjustments are generally very significant in terms of dollars. And when you add in penalties and interest and the risk that amendments can be made over a number of back years, the risk of getting it wrong can be extremely high, both in terms of dollars and in terms of reputational risk. So whilst it can be very costly upfront to manage transfer pricing, it certainly is best practice to try to manage transfer pricing as best as possible up front, because the cost incurred in getting it wrong or having tax authorities disagree with a transfer pricing position can be extremely significant. Next slide, please. The transfer pricing is has been analysed by the OECD, and it's fair to say, and it's good to say, that the arm's length principle is here to stay. It is not changing. There have been some considerations in terms of other types of frameworks to adopt in analysing multinational groups transfer pricing, including formulary apportionment, but that is not the case, and the arm's length principle is here to stay. What's fundamentally important in analysing transfer pricing arrangements is to look at actual transactions and what's actually occurring in substance. So whilst legal agreements are essential to explain the form of arrangements, the actual conduct between parties or the actual activities is probably almost more important. Legal agreements are there to explain terms and conditions, but looking at what's actually going on in practice is fundamental to determining whether the profit has been allocated to the right location where activities, value-adding activities, are being performed. So, for example, in relation to intangibles, owning intangibles, legally owning intangibles alone is not necessarily sufficient to generate a right to all of the income associated with those intangibles. You certainly would be entitled to a financial return if you own intangibles, but if you're not necessarily in managing those intangibles, developing them, exploiting them, making decisions around how those intangibles might be developed or enhanced, then you won't necessarily be entitled to all of the profit associated with exploiting those intangibles, and so some sort of allocation between ownership and management of those intangibles will be required. So in transfer pricing analysis, we separate the concept of legal ownership and beneficial or economic ownership. We look at activities and we look at decision-making responsibilities, and these are perhaps, whilst they're not different under the revised OECD guidelines, it's fair to say that there is a sharper focus in relation to these elements. Next slide, please. One of the most important changes or improvements in the OECD guidelines in relation to BEPS Actions 8, 9 and 10 is in relation to a detailed risk analysis framework which has been incorporated into the OECD guidelines. This is not complex, but it's very detailed, and it provides a very comprehensive analysis of how an entity might go about looking at risk. So identifying risk, looking at how risk is actually managed within the organisation, and in particular focusing on who is controlling risk and who has the capacity to bear the risk and who makes decisions associated with how that risk is managed. So risk and intangibles are two areas with particular additional focus that have been included in the OECD guidelines, and are probably areas which can lead to perhaps most disputes in transfer pricing. Next slide, please. A very important action, number 13, is a transparency measure to provide tax authorities with information about a group's supply chain globally, including looking at activities, where activities are performed and where profits are actually allocated. So there has been a three-tiered approach recommended by the OECD, and it's up to each country to implement legislation in their domestic jurisdiction to require disclosure and filing of information with tax authorities. The master file, local file and country-by-country report has been prescribed by as three tiers of information to be prepared by multinational groups, and that only applies to multinational groups where global turnover exceeds 750 million euros, and it applies from calendar 2016, with first filing commencing in December 17. Now, not every country is going to require all of the master file, local file and country-by-country report to be filed, but the minimum will be that country-by-country reports will need to be filed in each parent's jurisdiction, and then master files and local files will need to be prepared, and you can see on the slide there the type of information that will be required, which is consistent broadly with the structure within the OECD guidelines in terms of preparing transfer pricing documentation currently. Next slide, please. So the transparency measures, as I indicated, are intended to allow tax authorities to use this information for risk assessment purposes, not for adjustment in making adjustments to taxpayer tax returns. But importantly, different tax authorities will have different views about what that information means, and different tax authorities with different levels of sophistication or experience may indeed have different views. Implementation is probably likely to be staggered by different countries. So, for example, there are some countries who will be early adopters, and Australia is one of those. In fact, probably the first adopter, because Australia introduced and passed legislation just last Friday to implement BEPS Action 13 and country-by-country reporting. There'll be other countries that want to wait and see what other jurisdictions do and how other jurisdictions approach filing of what particular information needs to be filed locally. And there'll be unilateral action taken by some countries as well, and the UK and Australia are two examples already where the UK has introduced a diverted profits tax. Australia has introduced legislation to deal with PEs, and maybe Dirk will touch on that a little bit later. Next slide, please. So what are some of the really practical issues in relation to the country-by-country reporting? As I indicated, different countries will adopt different rules, even so far as how the threshold is determined. So the OECD guidelines are based on Euro 750 million, so if your group has turnover exceeding 750 million euro, then you are caught within this net of country-by-country reporting. But as each country introduces their own legislation to give effect to Action 13, their local legislation will deal in local currency and not foreign currency. So what we are starting to see already is exchange rate bracket creep. So for example, in Australia, the threshold test is 1 billion Aussie dollars, which currently equates to about $680 million euro, but about a month ago when the Australian dollar was weaker, it equated to $620 million euro. So you can end up in situations where countries exceed the threshold based on domestic legislation in one country, but not necessarily in all countries, simply because of exchange rate variations. Exchange of information between tax authorities is going to be the first port of call in terms of how the country-by-country report or template is to be shared. And so some countries that haven't implemented country-by-country reporting at all yet in their local legislation may indeed be entitled or receive information even though they haven't implemented local law. One of the more significant concerns that our clients are talking to us about in relation to this filing of this information is the confidentiality and protection of such information by all tax authorities. So perhaps some more sophisticated tax authorities one feels comfortable about, but there are many countries where perhaps the information and systems that are in place are not as tight as other jurisdictions, so the fear of information may end up. And certainly most countries have to be very careful that it doesn't end up in the public domain. As an organisation, what systems and processes do you have available to collate information in order that you can even provide the information that's required in this country-by-country report by December 17 when it's required? And the different filing requirements will be really important in terms of practical considerations. So, for example, just giving you two comparisons, the UK has decided that it will only require the filing of the report itself, but not the master file and the local file by December 17, the year for the first report to be filed. On the other hand, and to the other extreme, however, Australia, in its legislation that has been passed, as I say, is going to require filing of the master file and the local file at the same time that the report is due. So, for example, if Australia receives the report through exchange with a tax authority, then that's fine, but it will also require the master file and local file to be lodged by the local entity. If Australia can't get the report filed, then it will get it will require the local entity or one of the companies in the group within that local jurisdiction to file all of the report, the master file, and the local file. So one can see how there will be some inconsistencies between jurisdictions with the information that is going to be made available, all or limited. Next slide, please. So most importantly, what we're recommending and what we're talking to our clients about is undertaking a dry run. And you would really want to do that dry run for 2015 on the basis that 2016 is the first financial reporting period for country-by-country reporting. So have a look at your systems and your resources. What do you have in place? What do you need to prepare the information necessary for the reporting? We highly recommend that you undertake an independent review, put the hat of a tax authority on, have somebody independently look at what your risks and issues are in relation to the report if it was filed. Where are there any mismatches in terms of what the economic substance of what's going on in your organisation or your group, Crossborder, and how that compares with the actual profit outcomes that have been allocated on a country-by-country basis. Look for changes between transfer pricing policies or arrangements, maybe 1 year, 2 year, 5 years ago, and how that compares with what's actually going on in practice now. As we all know, businesses evolve and change over time and people move on. And so what is really actually happening now compared with what the transfer pricing policies and or agreements prescribe? If you address these issues during 2016, you may have the opportunity to make modifications or changes such that you can improve favourable disclosures in the report that's ultimately filed with tax authorities. And most importantly, engage with senior management and the board for support, both in terms of making any changes that might be required, but also in terms of budget and resource that might be required for your organisation to address any potential BEPS issues so that you do become BEPS ready. I've listed there on the slide just some examples of transfer pricing risk areas for professional service firms. I don't propose to work through all of those, but often you have multi-jurisdictional projects that cross borders. You may have shared systems or processes. There may be shared intangibles. There may be use of know-how or brands or trademarks across borders. All of those types of interactions give rise to transfer pricing issues that need to be managed, need to be priced, and need to be determined on arm's length bases in order for you to be properly allocating profit across different jurisdictions. Next slide, please. I'd like to just make a couple of very brief observations in relation to Australia, given that's my location. Importantly, Australia has already endorsed the BEPS action plans and has been heavily involved in the BEPS debates and the development of the BEPS actions with the OECD, and has already commenced implementing actions, as I mentioned, particularly in relation to Action 13 and some other actions that are in the pipeline. We have updated transfer pricing law in Australia. It is very robust. It deals with reconstruction provisions. It deals with self-assessment. We have very significant penalties, 25% where transfer pricing documentation hasn't been prepared, 50% if there's no transfer pricing documentation and tax avoidance is present, or if you're part of a multinational group with turnover of greater than 1 billion Aussie dollars, those penalties have just been increased to 120%. if there's tax avoidance involved. So a very aggressive and extreme environment, and also with unlimited amendment periods prior to 2014 when our law was amended. And so when adjustments are made, they can go back a long way, and they can actually be very, very significant in terms of unpaid tax, penalties and interest. Next slide, please. As I mentioned, we have introduced the transparency measures, Action 13 already in Australia, and under our law, as I mentioned, the master file and the local file must be lodged with the tax authority. It only applies to groups where the equivalent global turnover is Australian $1 billion, but it's regardless of the size of the local entity. So you might have a very small entity in Australia, but they still need to comply with the country-by-country reporting, which means filing locally the master file and the local file, regardless of whether that's required to be filed overseas. Next slide, please. So what do you need to consider as a professional service group in relation to BEPS changes? What do they mean for you? I think it's fair to say that all BEPS actions need to be considered and what, if any, issues need to be addressed within your organisation. We see that there's likely to be an increased number of disputes across the globe because of, as Anna mentioned before, increased demand for the global tax share. There's only so much to go around and lots of different jurisdictions want their fair share of the pie. We think that there'll be an increased number of advanced pricing agreements, or APAs, to try to resolve disputes before they arise, but equally a very increased number of mutual agreement procedures, or MAP negotiations, where disputes have commenced and need to be resolved through mutual agreement procedures with treaty countries, between treaty countries. Regardless of your size, there could be increased scrutiny of transfer pricing, and it's no doubt whatsoever that we are now operating in a much more uncertain environment for tax and for transfer pricing, which will continue for a number of years while the BEPS changes are bedded down. I'd like to now hand to my colleague Jay, who's going to address some specific developments in relation to China.
So, thanks, Sarah. So, before going into the detailed implication of BEPS for professional service firms in China, I'd like to give you some general background on China's observations on BEPS. China plays a very active role in the BEPS discussion at OECD, hoping to upgrade the tax regimes and to improve the domestic tax legislation and tax systems. In the meantime, China also wants to enhance the cooperation with other countries and protect its own tax base with a more stable and transparent tax environment. The way China implements the BEPS recommendations is to consider the China-specific issues, for example, location-specific advantages, including market premium, location savings, etc. With the growth of its economy, China will continue to emphasize the things such as China-specific issues, but also keep an open eye and a big portion on some other areas, such as intangibles, control foreign cooperation. Here is a list of the key important action plans that some high-level tax officials of SAT, the State Administration of Taxation in China, mentioned in different events. So we believe that these will be the key focus within the Chinese Tax Bureau regarding to the BEPS action plan. We also find many of them have already been addressed in the draft of the new China TP rule, which will be finalized shortly. So in conclusion, the action plans that China will take in the near future regarding to BEPS will include, first, China will revise the domestic tax laws and regulations. For that, we already see that the SAT has released the GAR, the General Anti-Avoidance Rule, and the revised tax and administrative rules, along with the revised draft of the new China TP rule. Secondly, China will also try to localize the BEPS action plan, specifically for fitting the country-by-country reporting into the local compliance requirement. Thirdly, China will try to adjust the tax authorities in international tax administration divisions. It is believed that there will be a huge increase of the personnel within the international tax divisions of the Chinese tax bureaus. China will also continue to establish the national tax risk monitoring system, as it already has in some of the locations, such as Shanghai, Jiangsu, and Beijing. China will also use information technology to facilitate international tax administration and international information exchange. Now, I will share with you some of the key issues that professional service firms face regarding to transfer pricing and BEPS in China. The first one is outbound royalty or franchising payment. This is the major problem that many professional service firms will have in China. Many firms even find it very difficult to remit the amount to overseas firms. Normally speaking, the royalty or franchising agreement must be registered at the tax bureau first. Some considerations that professional service firms must have are, first, what is the value of the global brand in China, whether there is any local developed IP other than the core IP license to China. Second, routine professional technology and knowledge versus the high value added ones, which of them plays more important role in the day-to-day operation of the China firm. Last, the tax method of benefit tax at the current stage, especially for loss-making entities. Generally speaking, companies with operating loss are very difficult to pay royalties or franchising fee to overseas because the Chinese tax authorities do not think such IP brings any benefit to the operation of the Chinese entities. Other situation that the Chinese firms will end up with a loss position after paying such royalty or franchising fee is also not allowed for such payment. Inter-office billing is another headache for professional service firms in China. We see the Chinese firms receive billings from overseas offices at their standard hourly rates that are lower than the discounted rates that the Chinese firm will have when they bill the external Chinese clients. Therefore, the selection of TP method to evaluate such charge will need to be considered, and in many cases, a comparable uncontrolled price is always applied. Similar to the royalty franchising fee arrangement, inter-office billings and service fee charge from overseas to China also need to be reviewed and approved by the local tax authorities in China. The Chinese tax officials may evaluate the substance of the service activities conducted by the overseas affiliates, as well as the benefit that the Chinese firms receive. Service fees, such as management service fees, are not allowed to be deducted from a China corporate income tax purpose. We normally suggest that we look into details of these service activities and try to fit them into other categories such as back office service or other supporting services for deduction purpose. Other than the business tax or value-added tax levied on the service fee paid to overseas, the Chinese tax authority may also check if the overseas firms create any permanent establishment in China for its provision of services to the China firm. If so, a withholding income tax will be calculated based on the deemed profit rate generated from the onshore activities. Finally, the profit level of the Chinese firm is also need to be managed. Like what I mentioned in the previous slide, companies with losses are very difficult to be approved for the service fee payment to overseas, because the Chinese tax officials may hold the view that such services do not bring any benefit to the local Chinese firms. The last one related to professional service firms in China regarding to transfer pricing and BEPS is the contemporaneous documentation requirement. The requirements in the new China TP rule give a three-tier structure, which is similar to what is required in BEPS. Master file, in which the local companies are required to provide more detailed information on the overall group and the whole supply chain. Local file, in which the Chinese firms are required to disclose information that was previously required by the old TP rules. Special issue documentation report, which only applies to related party service transactions. For example, the one that I mentioned in the previous slide, the inter-office billing, cost sharing arrangement, and also companies who exceed the FinCap threshold. The country-by-country reporting requirement in China maintains the similar threshold as it is in the BEPS action plan. The ultimate holding entity of the taxpayer is outside PRC, but the taxpayer is assigned by the group as the reporting entity for the country-by-country report form. So that is all for the China part. Now, I would like to pass the microphone to Michael, who will talk more about the interest deductibility. Thank you.
Thanks, Jay. So we're now going to move away from transfer pricing and take a look at a couple of action points that are designed to improve the coherence of the international tax system. So cross-border intragroup financing has for a long time been a favoured way of multinationals to strip profits out of one country and move them to another, or even to move them out of the tax net altogether, as we may get a situation where a tax-deductible payment in one country is excluded from tax in the recipient country. So it's no surprise that we have actions addressing both interest deductibility, which is Action 4, and hybrid mismatches, which is Action 2. So looking first of all at base erosion through excessive interest deductions, Action 4 is proposing a very simple approach, a fixed ratio approach, which would limit the interest deduction for an international business to somewhere between 10% and 30% of EBITDA. And the idea is that this would apply to both internal interest payments and interest payments to third parties, although there could be a 10% uplift applied for third-party interest payments. The proposal here in Action 4 accepts that modifications in domestic law could be included which allow a higher interest payments in certain circumstances, or which could allow some kind of averaging of profits over a number of years. And this is particularly helpful if EBITDA is fluctuating a lot for a business. Some observations on the Action 4 proposals. The OECD, in the documents issued on Action 4, recognised that introducing such a change could result in a multinational business having to restructure its international financing arrangements. And they recognised that this could take some time, so they therefore recommended that when countries introduce these laws in domestic provisions, they have some kind of grandfathering rules to ensure that the multinational has time to carry out the restructure. The OECD have also said that the rule is regarded as best practice, so it's not something that they are saying is mandatory for all countries to introduce. And what we may find is that some countries choose not to implement it. So, for example, in the UK at the moment, we're currently undertaking a consultation process to determine whether or not we would like to introduce the rule. But we know in other countries, for example, the Netherlands, it's likely that they will probably stick with the existing targeted anti-avoidance rules that they currently have and not introduce this fixed ratio. And one of the concerns that we have with this kind of approach, with different countries adopting different things, is that we could have some kind of double taxation arising on an international basis. Moving on now to Action 2. So, I mentioned earlier, not only were multinationals eroding their tax base through excessive leverage, excessive interest deductions, but frequently the leverage structures involved hybrids. Now, hybrid can be either a hybrid instrument, an instrument that's regarded perhaps as debt in one country, but equity in another, or a hybrid can be a hybrid entity. This is an entity that would be regarded as fiscally transparent in one country, but opaque in another. And the effect of using a hybrid financing structure is often that payments were being made within a group that were tax deductible for the payer, but the recipient regarded the income as tax exempt. Now, the OECD's proposed response has been to recommend changes to domestic rules and also changes to tax treaties. Changes to domestic rules involve denying the interest deduction for the payer, or as a secondary rule, if the payer country has not implemented this first rule, then the recipient country will tax the income. The proposed changes to the treaties are designed to ensure that the treaties cannot be used to override the domestic law and create the hybrid arrangements. The next slide sets out some important planning points if groups are looking at cross-border financing. I'll just pick out a couple of points on this slide. Firstly, the anti-hybrid rules do not apply to situations where you're just using tax rate arbitrage. So if you have interest payments from a country with a high rate of tax, which are going to a country which has a low rate of tax, then that kind of arrangement will not be affected by the anti-hybrid proposal in Action 2. Secondly, the rules only apply when there's an actual payment of interest. If there's only a deemed payment of interest, for example, where there's maybe a transfer pricing adjustment on an interest-free loan, or where you're benefiting from a notional interest deduction, which is something that can happen in a number of countries' tax systems, then these anti-hybrid rules will not apply. So what should you be doing in relation to your cross-border financing as a result of actions 2 and 4 in BEPS? Well, certainly if you've got anything that looks as though it could be regarded as a hybrid mismatch, then you need to consider whether it will be impacted. But more generally, as countries start introducing the fixed ratio rule, you need to think about whether or not the interest charges will be restricted, and if there's any risk of double taxation, and if there's any restructuring that you can undertake to move away from that. So I'm now going to hand over to Dirk Albert, who will talk through the tax treaty benefits points arising from the BEPS action
plan. About shopping. Yes, hello, this is Dirk Albert, and we are now talking a little bit about whether professional service providers are like shopping, because this action point is pretty much about treaty shopping. We will see in a minute. We have an example how treaty shopping could take place also with a professional service firm. I have one case where we have an engineering office, and this engineering office is licensing the trade name to other subsidiaries. And then in some countries there is a withholding tax triggered to such a license fees, and there can be other transactions as well. And treaty shopping is pretty much about whether you could bring another subsidiary or group company into the game where you can avoid this withholding tax. And this was a more or less common practice also with professional service firms. And now they said, okay, they don't want this treaty shopping without substance anymore in the BEPS project, and they said, okay, in a first step, there should be a clear statement in treaties that it's a common intention to eliminate double taxation, but without creating opportunities to have tax evasions or avoidance at all. So there should also be no double non-taxation. This is more or less only a statement, and now they decided, okay, in the most double taxation treaties, there should be a specific anti-abuse rule, a limitation on benefits rule. And we know this already from the double taxation treaties with the US. Such limitation on benefits clauses are very common in those treaties. And it's more or less, you look onto the ultimate beneficiary of those license payments or dividends or whatever, and if this person who is benefiting from the transaction finally gets some kind of withholding tax avoidance or whatever, then this is not a problem. It is a more or less a mechanical test where you say, okay, you have various tests. For example, if there is a listed company, then it's always assumed that this company has the final benefit out of the transaction. And there are other tests which come along with this limitation on benefit clause. And then there is a more subjective test. It's a principal purpose test. You look at a transaction, and if you say then that the main purpose of this transaction is only to avoid any withholding tax, then this treaty benefit is not granted anymore in such a situation. And yeah, the tax is always one purpose, and so it's very important to bring substance to structures to see that there are other purposes which can be highlighted, so that everybody comes to the conclusion that tax is not at least the main purpose. And for sure, there are some unilateral anti-avoidance regulations, and they want to also have some opening clauses in the treaties to allow those domestic rules to apply. And now let's have a look at an example. Let's assume we have the company T, who is the headquarter, and they have a subsidiary in another country S. And if there was a direct license from T to S, then in country S, there would be withholding tax triggered. But if company T is first transferring or licensing the brand name to company R, let's say another subsidiary, and company R is sub-licensing it to company S, and if there is a double taxation treaty between S and R, then the withholding tax can be avoided. And now, with the new rules, we have to go through all those tests and have, for example, the test, okay, what is the principal purpose of this transaction? It's only avoiding the withholding tax, then the treaty benefit between S and R would be denied, or is there some other reason why company R is included in this transaction? So what do we have to do now with those new rules? So we have to increase substance and activities and to see that there is more than a tax avoidance purpose in those transactions, of including, in our example, company R. And if we are able to prove that there are other reasons, then old structures might still create a benefit also in the future. And if this is not the case, we could consider alternative ways to avoid withholding taxes. So, for example, think about transfer pricing. Perhaps there's a way where you can decrease the license fee so that the amount of withholding tax is lower, so at least the effect is a little bit lower. One example would be if you in the past licensed some software to another company. Perhaps you can offer this as software as a service, and perhaps services are not triggering any withholding tax in such situations. And if we had such structures which were mainly focused on treaty shoppings or treaty benefits, and if they don't pass those tests in the future, then one would think about whether they would remove such group structures if they no longer meet the tests. And then perhaps more important than the treaty shopping for the professional service firm are the permanent establishments. And in the BEPS projects, the OECD want to avoid the artificial avoidance of PEs, and one focus is on agents and commissionaires. In the past, if somebody, let's take, for example, an engineer which is somewhere in the country where a construction site is, and he is concluding contracts on behalf of the headquarter. And in the past, this person had to conclude contracts before somebody would assume there is a PE on the ground. And now, in the future, it shall be sufficient that this person played the principal role leading to the conclusion of the contract. And unfortunately, nobody exactly knows what a principal role is. We fear that there will be a lot of discussions in the future whether this person on the ground who did something played a principal role to the conclusion of the contract. And in the OECD papers which come along with those changes, there is an example that, for example, mere marketing is not sufficient, but convincing somebody to conclude a contract shall be sufficient. And I thought marketing is all about convincing somebody to conclude contracts with me. But anyhow, there will be a lot of discussion, and we need to be aware of if somebody is on the ground somewhere and concluding contracts, or at least playing important roles for concluding contracts, and if he's doing this on a permanent basis, if he's a dependent person, then the likelihood of new PEs is rather high. And we need to, especially to think about the current structures, because in the past, very often such PEs have been avoided, as in the agreement of those persons on the ground that didn't have the power to conclude contracts. So everybody thought, if this is in the agreement with this person, then there's no risk of a PE. But now this will change, at least when the treaties will be changed accordingly. Then there was another change in the past. Very often, if somebody had a construction site or installation sites, or even if it's, for example, in an engineering office, was only supervision some projects on the ground, and if this was done for more than 12 months in the most treaties, then a PE was created. So in order to avoid this, they tried to split up the projects and said, okay, we don't have a 12-month project, we have 2 8-month projects or whatever. And it was also one option to say, okay, if there are various subsidiaries which are involved in this business, we split up the business, and 6 months one subsidiary is active, 6 months the other subsidiary is active. So again, we could avoid the 12 months in the PEs. And now, due to this principal purpose test we discussed before, if the principal purpose is of this thing to get a treaty benefit, and if there's no reason why we split up those contracts, they will be aggregated and will be considered together. And this last slide of me is not directly connected to the BEPS project, but I want to make you aware of that in some double taxation treaties, China, India, Philippines, I made some examples here, there is something like a service PE. Normally, if you only provide services on the ground, if you don't conclude contracts, and if you don't play an important role for concluding contracts, then there should be no PE with the mere provision of services. But there are some double taxation treaties in some countries which have a different opinion of that, and you should be aware of it. Yeah, that's pretty much my thing about treaty shopping and PEs, so I would like to hand over to Malcolm again.
Thanks, Dirk. Sorry for the pause there. Now just going to take a quick look at preferential tax regimes and see how they have fared under the BEPS initiative. A number of countries have preferential tax regimes that provide low effective rates of tax on certain types of income, and typically the regimes apply to income from intangible assets and are designed to encourage higher value-adding activities to be located in a particular territory. So the good news is that the consensus from the BEPS review is that it is acceptable for countries to have these kind of regimes, but only if they relate to technology IP, and only to the extent that IP within the regime has been developed in that country. And this work resulted largely from discussions between the UK and Germany on the workings of the UK's patent box regime, and as a result of this work, the BEPS proposals, this regime in the UK has already been reformed. And what we're expecting to see is a number of other countries reform their regimes in a similar way. So just to round up, a lot of what we've been talking about today is making sure that if multinational businesses make profits, they pay tax on those profits, and where they pay tax is aligned to where the economic substance of the business is located. So the slide we've got here is a picture from a Banksy exhibition in Los Angeles a couple of years ago. It's entitled Elephant in the Room, and for me, economic substance is the elephant in the room. What it is often very hard to define, but increasingly it's becoming much more important to make sure a business identifies what it is in the context of their operations, and for a business to consider the tax strategy in the context of where you have the economic substance. So it's starting to creep more and more into all aspects of international taxation. So with that, I'll hand over to Anna for closing observations.
Thank you, Malcolm. What is clear is that there's a lot of uncertainty around the world in terms of the exact requirements of BEPS, but the actions do give outlines. So there's action that people are taking now and should be taking in the short term in order to meet the requirements, but it doesn't look like anything is going to move away from this agenda anytime soon. So increasingly, as we said before, governments are looking to bring in more tax revenues and be clear about people's economic activity and substance and where that substance is actually taking place. So I think we've got time for just one very brief question that's come through, and that's to do with transfer pricing documentation. I think a lot of people seem to be concerned about transfer pricing documentation, and one point that's been made that what if transfer pricing documentation has been put in place a couple of years ago? Are we going to have a chance to change it as a result of BEPS, or are we going to have to change it as a result of BEPS? And Malcolm, I just wondered if you wanted to comment on that particular question.
Yeah, thanks, Anna. I think one of the key things with the changes to the transfer pricing is a growing sophistication around transfer pricing. And I think companies and professional service firms are going to have to be a lot more focused on producing more comprehensive transfer pricing documentation in the future, and probably slightly different documentation to what they have done in the past. So perhaps in the past they'll have produced documentation on a service-by-service type of basis, whereas now we've got the three-tiered approach where you're going to have to produce documentation in the master file, local file formats, and also if you're big enough in the country-by-country reporting as well. So I think it's slightly different documentation you will have to produce. You're going to have to update it every year as well. So I think companies will need to start looking at which of their urgent priorities in terms of updating that documentation.
Okay, thank you very much, Malcolm. Right, at that point, I think we should pause and say thank you very much to the speakers and the audience for listening. We will be sending through the slides and a recording of the webinar, plus a survey that I mentioned earlier, to you all by email. The survey will give us some feedback on the webinar and also ask you for your views about additional areas that we should cover going forward. In the meantime, please do get in touch with any of us if you have any particular questions or any general points that you'd like to make. And I want to say again, thank you for listening and goodbye. Thank you.